I am very pleased to welcome back to the show Danielle Park, Venable Park Investment Counsel. She joins me on the line. She's the author of the book Juggling, Dynamite, is in demand all over the country. So I'm so pleased, Danielle, you find time for us here on Money Talks. Welcome back.
Hey, Mike, and I can hear you. What a bonus.
Yeah, there you go. Hey, let's get right to it then. You know, a few little technical glitches today, but I want to get right to it and have people benefit from your experience and your insights into the market. You know, we've had this massive rally coming out of the U.S. election. We've got the Federal Reserve. Looks like the market's saying at least 100% chance of raising interest rates. You look at the bond market, my goodness gracious, that's been a really significant change in yield there. Tell us how to make sense of all that.
Yeah, I think you've hit right on it. The main theme here is monetary tightening and potentially fiscal tightening. So if you think about it, when you look back on the stimulus that was deployed out of the 2008-9 recession, really you had a recovery of the global economy into something like 2011. And then since then, you had a lot of extend and pretend through additional credit injected by central banks around the world. But basically, GDP topped out, commodities turned back down, yields began to fall as the world realized that growth and inflation were evading us, and that, in fact, the demographics of the world, aging population, as well as slow growth, as well as excess capacity everywhere, was really a deflationary force. So yields have trended lower ever since bonds gained value throughout that period. But if you look at what's happening right now, so first of all, the rally in the sell-off in bonds since the Trump election, there's really two theses that would be the explanation. One of them goes like this. It says, well, he's going to stimulate so much, he's going to drive inflation and growth, and therefore rates will move higher, so bonds sell off. First of all, I don't buy that one, because even if he is able to get the fiscal stimulus package through that he hopes, the reality is that it's through deficit financing, which first of all has a very muted impact because you're borrowing to try and spend. Well, where do they get the money from? They have to take it out of taxpayers and they have to borrow more, and it doesn't affect in an inflationary way in the way that people hope. And second of all, there's a huge lag. It doesn't happen right away. But in the meantime, rates spiked, right? And rates spiking means that you've got this contracting credit effect going on in the world. So this hits borrowers immediately, even though the potential growth aspects of stimulus don't come for maybe a year or two down the pipe. So that's very negative for the world economy that's heavily indebted today. And then you've also got, you know, him talking about changing the rules around taxation, wanting to cap mortgage interest deductibility, for example. You've got similar things going on in Canada, where at the edges we're tightening tightening lending standards in the mortgage market. And so all these tightening influences, as well as this spike in rates, have really hit emerging markets in terms of people in the world that or have borrowed money in U.S. dollars, because rates were low, but they get their revenue in foreign currencies. So this is all very negative for emerging markets. Again, deflationary, back to suppressing world growth. So I think probably we may have seen as far as we're going to go in this leg of this rally in yields. I think you're more likely to see that yields roll back over here and that bonds gain value again, because, again, looking around the world, what are the options today? We've got a mess of huge proportions thanks to all these years of reckless lending and adding debt and adding debt. Now you've got, you know, China tripled its debt since 2009. The United States doubled its debt since 2009, and we're just talking about federal government here. So, you know, the world economy is that much more indebted today, and the people are that much older, Mike. You know, boomers have got that much older, and they're really suppressing this whole urge for wanting more consumption. It's just not materializing. So I think you're going to see, you know, not only that in Canada, just one other thing on the fiscal side. You see the government talking about making banks more responsible for their lending, retaining more of the risk. All that stuff goes to, again, suppressing appetite for lending, and it pushes down on the availability of credit. So I think, you know, this has been an irrational overshoot, I think, in terms of the sell-off in bonds since Trump came in. I don't think he's going to turn this thing on a dime, if he turns it at all. And so, again, you go back to where in the world Can people put capital to work? Well, if they buy the U.S. Treasuries right now, North American bonds are yielding, 2% higher, for example, than German bonds today. Plus, you've got a strengthening U.S. dollar. So they're picking up currency appreciation on top of higher yields. So I think you're going to see capital continue to flow back towards the North American bond market for a while longer here.
And the other last thing you said there about the strengthening U.S. dollar, which we've been witnessing here, and it doesn't go in a straight line either way, but I'm with you. I can't even understand why anyone would keep their money in a euro that's so weak and getting a zero, marginal or negative yield. I mean, why wouldn't you come to the States when you've seen that huge jump in their 10-year Treasury, for example?
Yeah, I think one of the things people forget, though, in making these kind of top-down assessments is that there's a lot of captive capital in the world that has to stay in certain currencies and markets. We see that, for example, with the QE stuff, the Bank of Japan and the European Union. They're requiring pensions and firms to buy their bonds regardless of yield. So there's a lot of money that simply cannot just, if you're a European resident and your expenses are in euros, it would be irresponsible of you to shift all your savings to the U.S. dollar just because you think the U.S. dollar is going up. Similarly for Canadians, if we're paying our bills in Canadian dollars, we're getting paid income in Canadian dollars, you don't put all your savings in a foreign currency. It's not prudent risk management on a individual basis. So I think that there's always reasons why people have to buy certain assets. And in the financial world, the world has been pumped full of excess finance, creating money out of thin air all over the world in central banks the past, since 2008. And so what that's done is really just pooled in non-productive pursuits all over the world. You've got money piled high doing nothing productive. Same thing that's happened in the Canadian real estate market. If you look at our economy today, our stool for leg on the energy sector went out from under us 2 years ago, right? The oil price collapsed starting 2 years ago, actually this December. So what did we do to sustain some growth and some momentum for the last, in that period as oil was coming down? We doubled down on the housing sector. Was that productive investment? No, it wasn't. It was foolish. In many cases, it's not even likely to be retained by the people who have bought it because they did it in such a highly levered fashion. So all we've done is manage to pile capital up in non-productive pursuits, bury people in debt. They've literally taken on a life sentence of debt payments here. And all of that, again, goes back to deflationary effects. So I think Canada's economy is now just lost our last stool because if you look at the investment in the real estate sector, which was 7.7% of GDP the past few years, which is lunatic fringe, Mike, way above norm. The U.S. cycle peaked at 6% of real estate investment as a portion of GDP in 2006, and it trended down to 3% and has barely recovered since. Canada went to 7.7, lunatic. And that means our mean reversion is going to be that much steeper. And in fact, what did we see quarter to quarter between the second and third quarter? We saw a decline of 5.4% of that investment in real estate. So I think Vancouver's been leading the parade here, and I think you guys peaked last February in terms of prices in that real estate market, and Toronto has to follow, and all the knockoff effects to all the towns and cities around. And I think that's going to be very negative for the Canadian economy and for Canadian banks. And I'm really worried about it because so many Canadians have flooded into these yield products, which are, mostly finance and REITs today. That's where the gargantuan, inflows have gone because people believed in that appreciating asset story about Canadian real estate and the knockoff effects on Canadian banks. But that's where everyone's huddled now in these egregiously valued assets, trying to collect their income and hope for the best. But they've exposed themselves to enormous capital loss potential here. And I think, that's just going to make it all that much worse.
Well, we've only got a couple of minutes. Can you just give me sort of the bottom line, Danielle, of, okay, so what should people, and I know it's a broad question, everyone should know you've got individual circumstances, but sort of a guideline, what their portfolio should look like today?
So what I think, first of all, Canadians have doubled down on investing in real estate as a surrogate because our stock market has gone nowhere. You know, we're below where we were in 2008, 2011, 2014. We flatlined. Stocks have really been a bad use of capital the past few years. And so I think people have really doubled down, as I say, on real estate as a surrogate, hoping that that would work. I think what they are now is like the tech investors in 2000 who, you know, over-concentrated in that one sector, didn't sell because they didn't want to trigger any tax and they thought that it would only go up. I think way over-concentrated today. So Canadians should look at their real estate exposure. They should look at ways to downsize it wherever possible. If you've been holding properties and you're levered and things have gone up, great. Take your money off the table wherever you can, because the demographics don't support a lot of buyers for this overvalued real estate. China just capped its outflows yesterday. Did you catch that, Mike?
Yeah, I did.
They have capped the amount of money that can leave the country. That's only going to restrict liquidity further, and the liquidity that has been driving this unreasonable gain in Canadian real estate. So the message I would give to people is look at your overall net worth. If you're highly concentrated in Canadian real estate, realize you're like the tech investors in 2000 and the commodity investors in 2008. You thought you were investing, you've been speculating for the last couple of years. Take money off the table, lower your leverage, increase your cash. Have a lot of liquidity, because there's some awesome value going to come down the pipe here, and you want to be ready for it. You don't want to be huddled in these insanely valued assets like Canadian financials and REITs and real estate exposure. I mean, it's off the charts.
I got to hold you there, Danielle. Thank you so much for your patience today. Juggling Dynamite.